Lecture 3. In this lecture, we're going to talk about how to adjust accounts for financial statement. Then we're going to talk a little bit about the cash flow statement. In the previous lecture, we talked about how to analyze and record financial transactions. Then, in order to complete whole accounting cycles, we're going to do the rest of things, including adjusting, reporting, and then closing. And these things are done by the end of the accounting period. Right, let's review some of the accounting terms. Chart of accounts. Chart of accounts is a list of titles and the numbers of all accounts found in the general ledger. The assets will start with 1, right? 110 will be cash. Liabilities start with 2. The equity start with number 3. Revenue and income start with number 4. Expenses start with number 5. Right, so all these things can be found in the general ledger. So what is a general ledger? General ledger is listing all accounts and their balances, just like a book holding all the pages. Pages means accounts holding all the pages. We call this general ledger. Then general journal. General journal are just chronologically record business activities. We call this general journal. The accounting cycle starts with journalizing transactions, in which we're going to record transaction in journals. And after that, we're going to post numbers from the journals to the ledger. Okay, so let's talk about this process. So a company signed a 2-year note to borrow $12,000. We have seen these transactions before. So journal entry, let's talk about journal entry directly. We're going to increase our cash and we're going to increase our liabilities. Remember, increase cash, that's a debit. Increase liability, that's a credit. So we debit cash and we credit liability, not payables, $12,000. Right? We have journalized the transactions. The next step, we're going to post those numbers into their ledger, which holds all the T accounts. So we're going to post $12,000 debit to the cash T account, where this left-hand side is a debit. We're going to post a credit to the not payable T account. Right? So from transaction 2 to transaction transaction 12. Okay, please study these transactions to see how numbers are posted. So I'm going to skip this part. Basically, the idea will be the same. And I think we have covered all these transactions in the previous lecture. So the purpose is to see how we're going to post numbers into their T account. So after we have recorded all the journals, we're going to have the general ledger before adjustment. Before the adjustment, we're going to have all the assets, liabilities, right, equities, and revenue expenses account. All of these numbers are being updated by the end of the period, but before adjustment. Alright, so how do I check briefly whether these numbers are okay? So here we're going to talk about trial balance. Trial balance basically is a list all these accounts, okay, in columns. So I can have a total debit equal total credit. So this is what we can do. So I can go to a Excel sheet and build a trial balance before adjustment. So on these columns, I'm going to list all the assets account, followed by liability accounts, equity accounts, and revenue accounts, expenses accounts. I have a total. And I have two columns. I have a debit column and I have a credit column. All right. So let me post numbers to the trial balance. Cash. Cash has let me see, ending balance 10,460. So I'm going to post that into the debit column because cash has a debit ending balance. So I'm going to do the rest for all the assets account. The same thing for liability account. Start with account payables. I have $2,600 credit balance. Alright, so I'm going to post that to the credit columns. So I do the same thing for all other accounts. Okay, so by the end of the day, for example, we're going to have the same total debit and the same total credit. Then I finish this trial balance. Okay, if the total debit is different from the total credit, either you have post wrong number or you need to check the journal entry. Okay, something must be wrong. So this is the idea of the trial balance. It's going to help you check the results. Next, we're going to spend some time on the adjusting process, which is very important and could be more difficult. So account balances must be reviewed to determine if adjustments are required by the end of the period. Why? This is caused by the accrual accounting. So what is accrual accounting? We're going to recognize revenues regardless we have received cash or not. So by the end of the period, we're going to review all the unrecognized revenues. Okay, although we may have not received any cash, but we need to review all those transactions to see if we need to recognize any revenues. The same reason, we're going to review all their transactions in which we haven't paid anything, but we're going to review and decide whether we're going to recognize any expenses. It's because of accrual accounting. For all these adjusting entries, virtually will never affect cash accounts. Okay, we'll never record a cash accounts, and usually it's going to affect at least one balance sheet and one income statement account. Okay, another type of adjusting entries is that we have previously accrued. If we have previously accrued revenues or previously accrued expenses, now we have to review those transactions to see whether we need to adjust those accrued revenues or accrued expenses. In other words, whether those revenues has been realized or whether expenses has occurred. And we call those transactions deferral. We call those transactions deferral. So deferrals, we're going to deal with amount previously recorded on the balance sheet. For example, we mentioned prepaid rent, right? In the previous period, we have paid cash for future rents. That's a prepaid rent. Now it's time to review whether we have enjoyed 1 month's rent. If we have consumed 1 month's rent, now it's time to recognize 1 month's rent expense. We call this deferral. And then accruals. So both deferrals and accruals will be reviewed and adjusted. So there are 4 types of adjustment we're going to mention. Deferred revenues. Remember, the revenue example, right? In previous periods, we have collected cash from customers in advance for future sales or future service. We have received cash, and that becomes a liability. no revenue will be recognized. Now this period we have provided service or we have sent goods. It's time to recognize those revenues, and we're going to make adjusting entries for those deferred revenues and recognize revenues in this period. Is one of the adjustment. Next is deferred expense, right? It's also called prepaid expenses. We talk about that. The previous period we have prepaid rent. Now this period we're going to recognize the expense. Right, the next two is accrued revenues and accrued expenses. We're going to review all non-cash transactions to see if we need to recognize revenues or expenses, regardless we have paid or not. So there are 4 types of adjustment in total. So let's take a look at examples to see how we're going to make those adjustments. Deferred revenues. If we have received cash in advance, they will be recorded as liabilities because we haven't provided any service or sent any goods yet. Now, this period, if we have provided service or sent products, we're going to start to recognize those revenues. For example, right, in May, customer prepaid $300 for 3 months membership. So in the month of May, I think we talk about that. In the month of May, we're going to recognize $300, right, and revenue, and the credit cash. We debit cash and credit and the revenue. Right, we debit cash $300, increase cash, and increase a liability and the revenue $300. This is the journal entry we're gonna record in May. All right. Now, we are in by the end of June, for example. By the end of the June, okay, we have provided 1 month's service, member service, to the customer. So we're gonna recognize 1 month's or 1/3 of those prepaid membership. That's $100. Okay, so we're gonna recognize $100 revenue and reduce our obligation $100. So we debit and the revenue 100 and the credit sales revenue 100. Right, and we're gonna post those numbers. So by the end of month of June, what is my ending balance for an revenue account? Remember, if we check a revenue account, for example, this is a revenue T account. Right? By the end of May, I'm going to post $300 credit. Right? By the end of May. Then June, I'm going to post a debit $100 to this account. Right? So by the end of the June, we should have a credit balance $200 in this revenue account. right? Prepaid expense. If we prepaid something, that is our assets because they're going to provide us with future benefit. Situations that requires adjusting prepaid expense. Equipment, buildings, or vehicles, which we paid, right? We paid for those things, but we're going to recognize expenses later when we use those equipment, for example, or buildings. This can be viewed as adjusting for prepaid expense. Then we have prepaid insurance, prepaid rent, and we understand that when they are used up over time, we're going to adjust the prepaid asset and recognize an expense like rent expense. Supplies can also be viewed as a prepaid expense. Supplies are used over time, so we're going to recognize the expense, supply expense. So let's see some of those examples. Insurance. So remember previously we paid $800 prepaid insurance covering June through September. That's 4 months. Okay, so we know the monthly insurance premium will be $200. Now we have used 1 month's insurance, so by the end of that month we're going to recognize $200 expense. So we debit insurance expense, increase expense. At the same time, we're going to reduce this prepaid assets, prepaid insurance assets, $200. Okay, they will be posted. If you check your T account for prepaid insurance, okay, what is the ending balance for prepaid insurance after we post these credit? It must be $600 by the end of the first month, right? Then by the end of the second month, we're going to credit another $200, and this prepaid insurance should have a balance $400. Oh, that's how we adjust prepaid expense. All right, another type of prepaid expense is depreciation. Okay, we purchase, for example, equipment. Then when we use those equipment over time, we're going to recognize expense. This process in which we allocate expenses is called depreciation. The calculation for depreciation under the straight line depreciation method is very simple. That is asset cost divided by the estimated useful life. So number of years we want to depreciate. And unlike the prepaid rent examples, here to record the depreciation, we do not reduce the asset account directly. Instead, we're going to rely on this accumulated depreciation account to record the reduction of asset. This accumulated depreciation asset account, accumulated depreciation account is still an asset account, but it is considered a contra asset account because its balance is always negative. Okay? So this account is going to reduce our total assets, called a contra asset account. Right here we have an example. So the company's equipment cost $10,200 and was expected to benefit company for 5 years. So we're going to depreciate for 5 years. Depreciation expense for this month, be careful, for this month is the original cost divided by 5 years. This is going to give us the annual depreciation, right? But we are calculating 1 month's depreciation. We're going to divide it by 12 months again. And this is going to give us $170 depreciation expense for this month. And on these accounting equations, we're going to reduce equities because we have expense. And on the asset side, we're going to reduce asset, but through the contra asset account. So the journal entries, we're going to debit the expense. We debit depreciation expense. To be more specific, we can set up a sub account, right? Equipment, for example. We debit 170, and we're going to credit this contra asset account called accumulated depreciation, 170. Numbers will be posted to those accounts. And we're going to repeat this process for the next 5 years. Every month we're going to post 170. Or if you choose to post depreciation annually, that's fine. So by the end of the year, we're going to post a full year depreciation by making the same journal entry. How to report depreciation and related assets on balance sheet. And here's how we're going to report. The equipment itself, okay, the cost does not change. We do not change the original cost account. And then right after this account, we're going to report the accumulated depreciation. Remember, accumulated depreciation is a contra asset account, so it's negative. In other words, we're going to subtract these numbers from the equipment. So 170 will be subtracted. The net equipment is $10,030. We also call this net book value of asset. Net book value of asset. In other words, the net book value is original cost less any accumulated depreciation become net book value of an asset.